Well, the market's doing perhaps as well as they could do over the last couple of sessions. We ended last week strong, of course, coming off of a very weak base and a big drop. But last week, the best week since 1932, well, we continued some of that momentum today. The Dow ending the day up 690 points. Pretty much most stocks that you look at, the MAGA stocks, the FANG stocks, you name it, technology, they were higher today. We'll get to those. The one thing, of course, that was not higher continues to be oil, down another nearly 7% as well. We'll get to more on oil and what it may be signaling throughout the show. So welcome, everybody. We are very pleased today to be joined by Guy Adami, Tim Seymour, and Dan Nathan. And for the entire hour, we also welcome in Emily Roland of John Hancock Financial. Emily, it's a pleasure to have you back here on CNBC's Fast Money. Guy, you said it last week. You said that it seemed like the indiscriminate selling might be over. That gave you some comfort. Were you perhaps even more comforted by today's action?
Yeah, and it's great to see. It's great to be here. And I got to give a huge shout out to everybody in Englewood Cliffs for making this possible, to getting us all on. So thank you, number one. Number two, I hope everybody's safe, obviously. And number three, yeah, I take a lot of comfort in the fact that the indiscriminate selling appears to be over for now. And I'll add this on top of it. You know, the volatility index, which was rallying all week, which wasn't a great sign on the back of the broader market rallying, was actually down today in a meaningful way for the first time in a while, Brian. So, yeah, I think that's encouraging.
You know, Dan Nathan, I tweeted out on Friday, I think it was, or over the weekend, I basically said, if you've got to keep asking if this is the bottom, it probably isn't, because it means there's still this sort of buying bias in the market. Obviously, we've had a number of pretty good days, obviously, in what has been an awful year on many levels. Do you think the bottom is in?
Well, not really. I mean, a bottom is in, right? So the bottom of the panic selling that started in late February and followed through for most of March, that bottom is in right now. And I know that sounds a bit cavalier, but, you know, we had a 33% peak to trough decline in a little more than a month. That's unprecedented, right? So there was, as Guy said, a lot of indiscriminate buying. A rally was due. We've been saying that, I think, for the last week or so. So now we have a 20% rally off the bottom. I think we've talked about this over the last few weeks, Sully. I mean, when I look back to 2001, there were two 20% rallies off of lows that failed. In 2002, there were two 20% rallies off lows that failed. Go to 2008, there were two rallies of 20% off the lows. They failed. So this is a pretty common, it's basically a feature, not a bug of bear markets, and we're in a bear market. So, you know, the way I think about it here is that, you know, this is a great opportunity for traders. This is a really good opportunity considering that we're still down 20% from the highs in the S&P 500, a great opportunity for those people with a long-term view to start dollar cost averaging into names that you want to own for the long term.
Emily Roland of John Hancock, how do you see it, and what are you recommending to clients right now?
Yeah, we absolutely agree with that, and I think dollar cost averaging is the perfect way to approach this market. We're looking for a few catalysts before we can kind of shift to a more risk-on positioning here. We'd like to see the number of COVID-19 cases in the U.S. peak. We're weeks away from that, likely. We'd like to see the economic data bottom. It's just getting bad now, and we're likely to see more pain to come. The data that we're getting now does not fully reflect the damage that we're going to see from the virus and the containment measures. And then we'd also like to see investor sentiment, again, get to that point of capitulation. I'm talking to advisors every day, and even before this rally, they were asking me, where should I be putting money to work? To me, that's not really a sign of a market. The one thing that we do need to remember, though, is that bear market bottoms are breeding grounds for bull markets. If you look back at the last number of bear markets over the past 70 years, and investing at the bottom gets you 15% annualized over the next 5 years. Don't get too cute trying to pinpoint the bottom. The dollar cost average into this market is what we're telling investors.
So bottom line is you should be putting some money to work. And I understand your point about the COVID cases. Obviously, we want those things to peak out for many, many reasons. And Tim Seymour, every day before the show, right before the show, I take a screenshot of the Johns Hopkins site. We're up 20,000 cases from exactly this time we were yesterday. Do you believe that peak and that rollover, while obviously more important to humanity, will also be equally or maybe more important to the stock market, just from a sentiment perspective, like we're starting to come out of this gloom and doom?
Yeah, and the sentiment has been all about pessimism and expectations of a double bottom and another retest. And I think as we get into some of the technical elements of the quarter end rebalancing, and what was extreme redemption and closures of a bunch of hedge funds that were tapped on the shoulder by risk managers and said cut exposure aggressively. Then in many cases, especially at a lot of these hedge fund pod shops, were basically told to close their doors. I think we've heard about some of these big muni funds, some of these mortgage-backed, asset-backed funds. So anyway, I just want to emphasize that I think the market went through something here. And I think the market has largely priced in health. And so you back to your question, which is at what point, is that enough? Have we priced in a lot? Look, the data out of Italy is just absolutely sad, but it's better. And the numbers that came out today were as good as they've been in a couple weeks. So, yes, I think the key is what's on the other side. I think it's very, very difficult to in many cases, to handicap what the economics are. But what we're all trying to do, obviously, the duration of the health crisis affects the credit and all the dynamics in the underlying earnings profile of all the companies that we want to roll up our sleeves and look at.
And we'll do like the draft, Tim. We're going to do the snake. So we ended with you in the first round. We're going to start with you in the second round as well. What are you watching? Were you
snake
encouraged
draft. All right,
by
good.
The action in the semiconductors, the action in technology? What made you stay focused today?
Yeah, look, we're a market show, Brian, so it's nice to kind of be back to fast money for an hour and talking about things that I think are also part of the dynamics of markets and what they do. First of all, the fact that we don't spend always a lot of time talking about credit, but the rally in investment grade credit continues to be extraordinary. Some of this, though, we want to wait and see what investment grade really does after the Fed stops buying everything that moves. But there's also been a ton of issuance on the long end. So I just want to say that that's one of the things you have to be watching. Look, with great companies, and we've seen the haves and the have-nots. And if you look at companies, Apple is now above the 200-day. I'm not doing cartwheels over this, but if you look at the charts of a handful of companies, look at Intel, look at some of the names that have actually gotten back to a place where you saw stability. They actually may have began to have ground out a bottom. So I want to see that. I want to continue to see some of the data on obviously the virus. But I think when we look at where companies have priced in the impact of the health crisis, I want to reiterate, I actually think we've priced in a lot of that. The question ultimately is going to be, like, I want to look at what the job numbers look like on Friday. I want to look at, things like, what goes on with some of these regional Fed indices. Obviously, today's Dallas Fed was shocking. It went back to not only 2008 lows, but well through that. And we know that unfortunately is the center also of a lot of the problems in the energy sector. So was going to be extreme. But, credit, dollar, where the macro goes, we've got a lot of macro at the end of this week that's very important. We know it's not going to be good. But ultimately, good companies, Home Depot, Nike, have started to trade with some normalcy.
And Brian, I'm going to jump in real quick. In terms of what I'm looking here, I think we're all saying similar things in a different way. I'm not trying to be cute here, but there also might be people saying, you know what, this market still scares me a lot. Is there any more upside? And if so, where should I start looking to peel out of things? And this is something we talked about, I think, last week. We saw obviously that trough down to 2191 in the S&P 500, and off the recent high, the all-time high. If we just made a 50% correction of that move, it takes you to somewhere around 2790. So you're talking about another maybe 150, 160 S&P points to the upside. And that's maybe where we stall. So I'll stand by that. I'm with Dan on this. I think a bottom is in. I'm not necessarily sure the bottom's in. But I do think there's potentially, a little more upside to that 2800 level or so in the S&P 500. And I think that's what folks should be watching.
Yeah, so Guy, and I don't disagree with that. I would just say, look, what I'm watching today, the underperformance by the Russell 2000, the small cap, I think that is a bit indicative of the stuff that the S&P 500, the stock market in general, doesn't really focus on. And that, when you think about this health crisis that's morphing into an economic crisis, one of the things that cannot be accounted for in the stock market's gains or losses are the 15 million restaurant workers that are not that are not employed right now, the tens of thousands of cruise ship workers and airline workers and Boeing workers and auto workers who are being furloughed. I mean, when you think about what our economy is, 70% of it is the consumer. That's being stopped down. Their inability to access some of this financial assistance in real time is going to be an issue. So what I'm looking at is the Russell 2000. I'm looking at the underperformance in the bank stocks today. I'm looking at the underperformance in, some industrials, like I just mentioned before. Energy is a disaster. So you can get all geeked up again and buy the names that got us to the highs in February, but understand that the one thing that this bear market is going to take some time to heal for and to really make a bottom is going to be time. And I just don't think enough time has passed. So you may get to 2790 in the S&P 500. It may get to panic selling on the way back to those recent lows. I just don't know. I just think you want to be careful chasing the market here.
I mean, I'm looking at the fact that the markets don't really seem to care very much about economic data anymore. Does anybody remember when they did? I mean, we talked about the Dallas Fed Index today. U.S. service last week at 39.1. Unemployment at 3 million and climbing from here. And certainly we'll be watching Thursday. That could be 4 or 5 million. This is a remarkable thing. And I understand that we've got fiscal stimulus, policymakers, central bankers. Obviously, a lot of ink has been spilled on everything that they're doing to support this economy and prevent a more, sinister credit crunch. But we're looking at an environment here where the data could get much, much worse. And I think it's pretty interesting that we're just seeing markets look right past that. It's actually amazing.